Hey guys, welcome to the first episode of Wall Street on Westheimer. My name's Arnav.
And my name's Gaurav.
So, our agenda for the first episode will just be cover the past first, and then we can lead into the present since this is the introductory uh, installment. So, today is June 15th, and 2022, and in the past we've been looking at a fall in stocks per se, and a year-long economic recession. And overall, for the past since the market recovered since 2008, we've been looking at a pretty big bull market, and this has led to stocks, especially tech stocks and different, basically all stocks in all different sectors being overpriced, and this is before 2022. So, Gaurav, do you have anything to say about that?
So as Arnav mentioned before, a lot of these stocks since the 2008 recession, a lot of stocks have been really overpriced, and with the hit of inflation and some catalysts such as COVID, the Russia-Ukraine war, causing really high inflation and gas prices to go up. So all of those took a toll and were the catalyst for the start of the economic recession. So a lot of your favorite tech stocks, such as Tesla, PayPal, Amazon, they're down close to 30 to 50%. Some of them even more. So a lot of these stocks are really overpriced, and they're coming back down to what one could say a reasonable price. Especially if you look at 8-pillar analysis of many of these stocks. A lot of them have excessively high P to E ratios and additional factors that really signify that these stocks are really overvalued even at this point of time.
So, just to put into perspective, a good P&E ratio before this huge bull market was 20-1, and right now we're looking at multiple stocks, good value stocks being some of them being even up to 80-1. So that's just how overpriced things have gotten, and as a result, things are falling right now as we speak. Stocks are going down, and it's basically a market correction. And it's not just in the stock market; we're looking at it in the housing market as well. After a long 2020 and 2021, where you could say 600K homes jumped to 1 million, especially at least that's what happened in Texas. In Houston, Texas, probably even more in cities like Austin and California. Actually, maybe not California. People are leaving. So more upcoming cities like Austin and I don't really know, Boston probably. So we're just basically looking at a big correction right now. And so you want to talk about the Fed Reserve right now?
I think we should talk about the stuff that leads into the Federal Reserve.
Okay.
Specifically the results of the CPI. Recently, the CPI released the actual results of inflation across the year. The expected results were 18.3% increase in inflation. However, the actual results revealed that the inflation was up 18.6% this year. And while it may seem like a minute difference, that 0.3% really set the market into shock. The market was down 5% 2 days in a row consecutively. It really signified that the short relief from the beginning of the bull market had just ended, and now we're spiraling towards the big drop. If you happen to look at the graph of a bull and bear market, so what happens is there's a huge upward trend during the bull market, followed by a small dip, signifying the beginning of the recession. And then after that small dip, you'll notice that there's a short period of relief, which we've just crossed recently. And now we're spiraling towards the very steep decline as prices fall.
Okay. So here's something I just found. The S&P 500 officially entered the bear market 2 days ago, as it was down 21% from its high in January 3rd, 2022. And while the Nasdaq has been in a bear market since March 2022. This is the first time in a long time that the S&P 500 has dipped this much, and I don't really know how long a bear market lasts, so we can go ahead and say our predictions. So, obviously we're not financial advisors. We're literally 16 years old, and incoming seniors in high school. But this is just us sharing our thoughts.
Yeah. Additionally, historically, the average length of a bear market has been 269 days, but the bear market generally lasts anywhere from 6 months to a year and a half. It really depends on how strict the Federal Reserves are with their interest rates. They could be increasing it even further at later points just to battle inflation in a more strict manner. But generally, the bear market will last close to a year. So be prepared for a large recession and stocks continuously drop.
Okay, so here online it says the average length of an S&P 500 bear market is 8.8 months, and since according to like what I said before, where we just entered the bear market 2 days ago, we're looking at on average around February March of 2023 to stocks being recovered to where they were before, the market being recovered to where it was before. Okay, so I think that covers bear market unless you have something else to say.
I don't really have any other points. No.
Okay, so what do you want to move to next?
Let's move on to the current state, what to invest and how to invest. Currently, as we've mentioned before, interest rates are rising. The current climate with the Russia-Ukraine war, global policies on oil production has caused crude oil to drastically soar in prices. In the U.S., gas prices have hit an all-time high of nearly $5 per gallon.
Well, that's in Texas.
Yeah, sorry, Texas.
This place is hitting around $7.
Yeah. Which have really caused the profit margins for many oil companies like ExxonMobil and other crude oil companies, BP, many of those well-known names, have really risen in stock prices. So while they aren't like necessarily entering the steep recession of the bear market just yet, they are still growing. Do expect them to fall at a later date when many of these conflicts start ending.
Down.
Yeah.
Okay, so we've talked about inflation with the stocks. That's the reason why stocks are falling in the past year. Inflation has been kind of out of control. Do you know the exact rate? It's around like 6, 7, I think.
By how much increased last year?
Yeah.
It increased by 18.6%.
18.6?
Yeah.
Okay. I think it was 7 to 8 from this year. Like, from year to date.
Oh,
or
okay.
something. I can make sure real quick. Inflation this year. Yeah. Just below 8% of the first quarter of this... Oh, the first quarter of this year. So, and it was almost 4 times its level in 2020. So that puts into a broader perspective. And something interesting that I read the other day that I was discussing with Gaurav was that we all know inflation reduces the value of money, and it also reduces the value of a stock, since a stock does not follow like the inflation levels. If inflation goes up by 6%, stocks are not going to go up. The market's not going to go up by 6%. So some like companies like Goldman Sachs that I read about, they were investing in housing, because housing actually does go up with the inflation market. So these companies are buying out like full out suburban communities to keep their money in value, and they're leaving these homes like vacant. So that's also driving up the market prices, but overall we're seeing a trend that's going to go down. But these companies are kind of like doing something unethical, in my opinion. What's your
I
perspective?
definitely agree. With Goldman Sachs specifically, buying out full communities and reducing the available housing for the population. It really causes problems with many people being homeless, and especially with the prices of houses rising as well, right? Um, Houses become more expensive and harder to like acquire for many of these homeless people, setting these houses really out of reach for them when they could be a lot cheaper and affordable as they are a required need for survival.
Yeah, so they purchased 87 homes in Florida, and they're all rental properties. So, I mean, it's a smart move, but not really something that a company should be able to do, right? Okay. So,
Moving on from the real estate market, the crypto market has been really taking a big hit, with Bitcoin hitting a low of 21,000,
mm-hmm.
and many other coins failing alongside, such as the recent Luna fail, where the Luna coin had to split into a completely new coin, which is now known as Terra Luna. Um, Although that has been managed fairly decently recently, overall the crypto market is following that decline with Bitcoin, and don't expect crypto to be hitting an all-time low just because Bitcoin hit 20K. Many analysts predict that as the S&P falls to close to 30 or 40%, which is expected in the bear market, Bitcoin will drop even further. So yeah, don't expect to buy Bitcoin just now as it hit 20K.
Yeah. So, basically in the crypto market, if you look at like every single like chart, most of them follow like Bitcoin's pattern in the first place. Like Ethereum and Bitcoin are pretty much the same thing. Like I get notifications on Robinhood, Bitcoin's down 5%. I can expect another notification the next hour, Ethereum's down 5%. Like it's almost the same exact thing. It's just whatever. In my opinion, like the top 10 coins right now all follow the same pattern, and it's basically uniform to Bitcoin. So the whole crypto market is looking like Bitcoin right now, which at one point it was up to 70K a couple months ago, and now it's down to 21K. But yeah, that's how the crypto market's looking right now.
Well, we've covered how the economic state of the world or nation is currently. Let's talk about how to actually invest throughout the recession. As we all know, the bear market will come to an end within about a year or so, and the bull market will obviously follow shortly after. So, what to do throughout the recession is you have to be able to buy companies at a good price. That is the point of investing, right? You're buying companies at a good price and selling them at a good price to make profit. So what we're doing throughout the entire recession, it's impossible to predict when the actual bottom is, right? So what you're gonna do throughout the entire recession is something called dollar cost averaging. So every month you're gonna choose a point where you think it is a great buy for a company, and you're gonna buy in for that month. Every month you're gonna buy the same amount every month. So as you go through those short reliefs and short drops, you'll essentially be buying an average slope throughout the entire recession. And then when the market or the bear market ends and the bull market arrives, you're gonna be selling at that same dollar cost average. Just so you know, in case it is a short relief again, you'll be able to not sell everything at a low price, and you can consistently sell to make profit on each of your buys.
So another approach other than dollar cost averaging is diversifying your holdings, not just stocks, not just crypto, not just housing, but also bonds and especially dividend paying stocks. When the market is down, you want that. So a dividend is basically when the company pays its holders for holding their stock. So some common ones would be like I believe AT&T. AT&T is a big, Microsoft is a big one. So they pay you like a certain percentage of how much you're holding. So it's basically a guaranteed form of income no matter how the market is looking like. And they usually pay in quarters every 3 months. So that would be a good way to get a guaranteed source of income. And especially when the market is down like it is right now, down 21%. Bonds are also a pretty good investment during this time because because their prices are going to move in the opposite direction of stock prices, and basically everyone should own like at least a small percentage of bonds as it diversifies one's portfolio and basically gives one source of money other than stocks, especially when we're in a bear market.
And then the obvious answer throughout the recession is shorting. So with shorting, you're banking on the price falling. So you sell it at a high price to another person, and then you rebuy it at a lower price. So essentially, you're making money off the stock falling in price, which is gonna happen often during the recession. It's just a matter of making sure you're shorting at the point where it is not the short relief in the middle of the recession.
Mm-hmm. And another thing is, stop looking at like the short term. Stop looking at your portfolio every other day, like unless you're day trading. But like, it's gonna be down, down for at least a couple months. So, looking at your portfolio is just gonna bring your mood down. And if you stick to the strategy of diversifying your portfolio and dollar cost averaging, and not paying attention to how much your portfolio has gone down in the past few months, you should be good, especially when the bear market comes back around and all your stocks are at a gain. So focus more on the long term, and especially when a time period that we're in right now is pretty tough to endure.
Mm-hmm. And yeah, as Arnav was mentioning, it's really important to keep emotion out of your trading. Focus on analysis. So try the 8-pillar analysis. Look at the P&D ratio. Look at their market cap, revenue. Look at all the factors that like mathematically make a company a good investment with the for the price you're buying it at. Look at the analyst expectations for how they think a stock is gonna be valued at within the 12-month or higher period. So trade based off math throughout the recession, as you're most likely going to see your entire portfolio in red as all the stocks take a huge plunge. But remember, as Arnav said, in the bull market, all of the stocks are going to go back up and you're going to be in profit, maybe 2-fold, 3-fold, or even more based on what you exactly invest.
Oh yeah, I understand, Gaurav, you conducted stock sentimental analysis this past school year. So, you want to share your findings on that and how, like, the analysis and the discussion of your findings.
My research really covered like the bare minimum. So it was like how racism, gender, some of the major like social and political problems that we see in society, like the recent Buffalo shooting, and many other acts of racism that affect our society today. I mainly compiled the general public sentiment on many of those actions, like the negative actions that they do, and check their corresponding effect on the stock market. So specifically, when the mass shootings in Texas occurred, a lot of what's it called? Guns like help me out here. Like weapon producing companies really fell, like Lockheed Martin, which is a large
gun
producer. Yeah, gun producer for the U.S. military. So Lockheed Martin fell, and many other companies like it additionally fell alongside it.
Okay. So, what do you want to move on to next? We can talk about mortgage rates, and have we talked about the Federal Reserve meeting yet?
I believe we have, yeah.
Okay, so we can go ahead into the mortgage rates and the downturn, or like the beginning of the downturn of the housing market right now. So, I have an article pulled up by Lance Lambert in Yahoo Finance, published today, in fact, and it says that mortgage rates hit a high of 6.3%, and the real cost to buy a home has officially spiked over 50% in just the past 6 months. So here are the predictions. The predictions would be that the mortgage rates would go from 3.1 to 3.3%, but it is in fact hit 6.3%, which is practically, it is doubling actually. So mortgage rates, what happens when mortgage rates increase is homes become less buyable. So say mortgage rates were 3.1% this past year. What happens to the people that bought like $1 million home on their mortgage rates, but like that was barely in their budget? They are looking at like two options. They gotta make more money, or they have to sell their home that they just bought. So that's what's basically happening right now, and it's also causing housing to fall down, especially after 2020, 2021, when we were in a bull market. Everyone was making money, which in return increases the demand of the housing market, and houses from 500K jumped up to like 750, and so since now mortgage rates are at like 6.3%, those $1 million homes are gonna go down to 950 or 900, and the people that just bought these homes are selling it at a loss because they can't afford the new mortgage rate. So that's basically what we're looking at right now. To put in perspective, if a home buyer, this is by Lance Lambert in this article, if a home buyer took out a 400K mortgage in June 2021 at what it was then, 3.1%, they'd owe $1,708 per month. But at the rate it is now, they're actually paying an extra $600 per month. And that adds up. 600 times 12 is 7,200. So some quick maths, and they're paying an extra 7,200, which is a lot. So that's what we're looking at right now.
Yeah, additionally, tying things back to the Federal Reserve meeting today, when the Federal Reserve increased interest rates by 0.75% or 75 basis points, it makes it harder for many people to take out loans from the banks to buy their house initially, because the banks now require higher interest rates to pay back that loan. And additionally, with the current climate as well affecting the real estate industry, the COVID pandemic as well as the Russia-Ukraine war has drastically affected mortgage interest rates.
It's actually, I'm looking at it right now, it's actually affected the mortgage rates as well. So it's at 6.3% right now, but here it says, according to Zandy, who I have no idea who is, Zandy tells Fortune that the average 30-year fixed mortgage rate would be around 3.8% right now if there was no evasion occurring. So that just shows how much that one event overseas has drastically affected the economy of the United States. So you were saying something before I came in?
No, you covered it perfectly.
Okay.
Yeah.
So just stop it. we can just add like something.
Okay.